Hey everyone, this is Kirk here again at OptionAlpha.com where we show you guys how to make smarter trades. And today we're going to go over all of our trades for Monday, August 25th. Good start to the week, I thought. Still a lot of low implied volatility. We've seen kind of my watch list dwindle of trades that are able to have high implied volatility and therefore sell premium. And it's basically dwindled down to just a bunch of junk that's out there as far as premium. So what we have to do in this type of environment where stocks are just going crazy, S&P is continuing to move higher, the VIX is continuing to move lower, we've got to be diligent about entering trades that are right for this market. So not a lot of iron condors, credit spreads, strangles, straddles. You can't do a lot of those in this market. You've got to go back to making some of those trades like vertical debit spreads, which we did here today, and calendar spreads, which we've kind of built up a nice little piggy bank here of calendar spreads over the last 2 weeks. But you've got to go to those trades because that's what the market dictates, right? And I've had really a ton of emails over the weekend from people because we did so well with a lot of our credit spreads, and XOP being one of those that we closed out here today was another credit spread that was profitable. And believe me, these are really good trades to make. I love credit spreads, iron condors, strangles, straddles, any type of short premium strategy. But in this type of market environment, that's just not the best strategy to use. And the market doesn't dictate that we should be trading those types of strategies. So we have to trade what the market gives us. Don't take a square peg and shove it into a round hole. Don't take a credit spread and force it into a market that already has low implied volatility. You're basically shooting yourself in the foot at that point. So that's really the theme, and I just want to kind of cover that a little bit before we get over and talk about today's trades. Let's get into them right now. Let's first talk about Yelp as far as opening trades. So Yelp is a trade that we did for October, only because October premium and pricing was really, really well, and I'll show you guys what I mean by that here in a second, but it's really, really interesting how actually the pricing worked out on Yelp today, and hopefully just give you guys a little bit of insight by showing you this later on, what I look at as far as pricing, and just the difference in strike price selection can be a difference maker and if you make money or not, or how much you make and lose. But as far as logistics go, we went in and entered the 85, 82.5 debit put spread for Yelp. So that means that we bought the 85 puts, sold the 82.5 puts against those 85s to help finance that purchase, and paid a debit of 140. Now, if we actually go to the chart here, you can see where Yelp is, and just notice how parabolic it's gotten just in the last month or so. And this is really nothing more than just a trade that we're just, kind of going against the market here. We think that at some point this stock has to come back down, right? There's got to be some profit taking that takes place. The stock is up, I think, 9 or 10 days in a row in one direction, and not that it can continue, but it's just not likely to continue to move higher. So that's what we're doing, is we're playing the downside move here in Yelp, and we're doing this with a debit spread because implied volatility is astronomically low. So it's down the 0 percentile. That helped us move out even further than September and go all the way out to October for basically the same price. So we get a little bit of extra time to be right. But with our break-even price, we basically just want the stock to close anywhere below where it's at right now. We've actually got a little bit of a buffer in our break-even price, and I'll show you guys that here in a second. But anywhere below here, and we'll make a good chunk of change here with the Yelp trade. So if we actually go to the trade tab with Yelp, and you can see our position down in the bottom right-hand corner and left-hand corner of your screen, you can see our position here today. But what I want to show you guys is why we decided to go with the 85, 82.5. So over here, you can see that we have the 85, 82.5. If I did, and at the time that we actually made this trade, Yelp was trading a little bit lower than 82.5. But if I did 82.5, 80, and I just want to go ahead and set up this trade so you guys can see what it looks like. But if I did the 82.5, 80 put spread instead of the 85, 82.5, I would pay a debit that's a little bit less than what I'm making, or what I paid right now at 140. So I pay 125 versus 140. So I am paying a little bit less in fee. But what you'll notice here is that my break-even price on this trade, even though it's a very even trade, I make about the same as I lose, so my max profit and loss is about the same, but my break-even price is $81.25, which is more than $1 lower than where Yelp is right now. So what that basically means is that I have to see Yelp close below 81.25 to begin to make money on this trade, right? I need to be right in my direction and Yelp going lower. But more than that, I need to be right in the fact that Yelp goes at least $1 plus lower before I even start making money. So that's why we didn't make those strike price selections. And if we actually adjust the position that we have here to the 85, 82.5, just so you guys can see exactly what that position is, we paid $1.40 for it. Now you can see that our break-even price on this trade is $83.60, which is actually about $1 higher than where Yelp is trading right now. So just the sheer fact of choosing the right strike prices allowed us to give ourselves an extra $1 of buffer in our trade. So actually Yelp can go up by $1 and we'd still be okay, we'd still make some money. And it can stay right here and we'd still make some money. And it can go down and obviously we'd make some money. So this idea of strike price selection is very, very key concept and something hopefully I'm going to continue to talk about a lot more. And we're doing a webinar obviously this week on Wednesday and Thursday where we're going to talk definitely about some strike price selection and probabilities with credit spreads and iron condors. So definitely check that out. Okay, so that's the trade in Yelp. FXY, very, very similar as far as how we set up the trade, except we're trading the calls this time. So in FXY, we did the October 93.94 debit call spread. We paid about 53 cents, little over mid price of about 50 cents. The width of the strikes is about $1, so we usually like to pay about 50 cents or half the width of the strikes. In this case, we paid a little bit over that at 53 cents. The logistics are that we bought the 93 calls and sold the 94 calls against those to help pay for it. So that reduced our cost down to 53 cents in total. So our break-even's around 93.50 for FXY. Really what we want to see happen here for FXY is a big move higher. It's been really, really beaten down. And you can see here on the chart that it's really had a very, very tough August and July, and it's just continuing to move lower. So again, bucking the trend here, we're playing the reversal. At some point between now and October, we've got almost a month and a half here to make this trade. Between now and October, we're just assuming that FXY trades anywhere above about 93.5, which is actually down here just a little bit more. So we just wanted to trade anywhere above here, give us an opportunity to make some money on this trade. I really, really like this trade. I think that the yen's been beaten down pretty hard, so we could see a nice little reverse happen at the end of this month or maybe even into October expiration. But we've got plenty of time on our hands since we went ahead and did this out to October. The third trade that we entered today, and I know this one was just at the end of the day, believe me, I know, and I'm sure I'll get emails from people who are going to complain and say that they got it at the end of the day, but hey, that's when I got it. I got it 3 minutes before the end of the day, and I send out everything to you guys the exact time that I get it. So if I get it a minute before the close, I'll send it out just so you guys can know. But good thing is with this calendar spread in lows, the pricing shouldn't change that much between today and tomorrow, so you should be able to enter this trade on Tuesday, right at the market open or very, very close to after the market open or soon after the market open for around the same price of about 31 cents. So don't go crazy. I know the alert went out late, but again, it was sent out. We got filled late in the day, about 3 minutes before the close, so we send out all the alerts to you guys right away as always. But we went ahead and bought a call calendar spread in lows. Now I want to talk about actually why we did this in lows when we already have a debit put spread in Home Depot. So we're already short Home Depot, and I do think that these two stocks in general have had a pretty huge jump higher. And I'm not particularly bullish on these stocks. Both Home Depot and Lowe's are still in the same building, housing market sector. But I wanted to kind of hedge just a little bit of that Home Depot trade, which is a little bit of a bigger trade, with a Lowe's call calendar. So if Lowe's continues higher and Home Depot continues higher, at least we have a little bit of a hedge on here for the future and possibly have an opportunity to close out both for a profit in the meantime if one rallies and the other falls or whatever the case is. So with Lowe's, we went ahead and did a call calendar spread. So we're all sticking to the 55 calls, both sides. We bought the back month, which is October, and sold the front month, which is September. So that buying and selling created this debit of 31 cents. It's a very cheap investment in our portfolio, and just, again, a good way to hedge a move continuing higher for lows. And it's all the way out of the money, so it's a little bit out of the money, but again, you'll notice that we're definitely bearish on both of these stocks. Lows, very similar to what we saw in some of the other trades that we've made, that it's just had a runaway couple of weeks, and that's fine. I just don't think it's going to continue, and I think at least we're going to have some cyclicality in here that's going to pull back or retest some support levels before continuing higher. So for lows, though, if we look at the Analyze tab, you'll notice that our calendar is a little bit out of the money. And again, this is more of a hedge against Home Depot continuing higher, so our calendar is a little bit out of the money. It's just out of the money to a little bit further than we like. We like our break-even point to be right at where the market's trading, so we're about $1 off of that. But with lows, the only strike prices you could choose from are the 52.5s, which are about here, and the 55. So there's nothing in between at, say, 54 or 53 that we could have chosen from, or else we would have done that and just moved it or inched it in just a little bit more. But you'll see that we have a very nice range that lows can trade in. So lows can trade anywhere between about 53.25 all the way up to 56.75 or so. So very, very massive range for us to make some money on this trade. But again, more of a hedge for our Home Depot position. It doesn't completely hedge it, and we don't want that. We're still very bearish, but we want to start adding some of these trades in case we get some incremental moves in the next couple weeks. Okay, and the last trade that we closed out is another one of these profitable credit spreads that we entered into a couple weeks ago. When the market was lower, we had a lot of investment into some of these credit spreads and iron condors. We've closed out a ton of them at profits, so they've all been very, very good trades, very profitable trades, which definitely helps. So for this one, this was XOP, which is the oil and gas ETF for the spiders. We went ahead and bought back our credit put spread that we originally sold. We originally sold the 69.67 credit put spread. Bought it back today for a 7-cent debit. And again, here's the reason we bought it back. We have these trade all the way out till September, so another 25 days. But in 25 days, all we could make if this thing decays and becomes worthless is another $7. So we've been in this trade for about 2.5 weeks or 3 weeks or so, and we've made $31. Why would we stay in this trade another 4 weeks just to make another $7? So it really comes down to use and utilization of your capital, making sure that you're not in trades that you shouldn't be in. This is a very profitable trade. We don't need to squeeze every last drop out of this trade to make money. But at this point, we're going to get out of it. If you want to stay into it, obviously you can, but you're really risking only or looking to make about $7 for the next 25 days. Not the best use of your capital. I think it could be used better elsewhere. So for XOP, though, I wanted to show you guys the chart because two things happened that we ideally wanted to happen in oil and gas. One, the ETF moved higher, right? That obviously helped because we had the positions down here in the upper 60s as far as strike price. But two, we saw that drop in implied volatility. So we traded exactly what the market gave us. And even though we kind of went right ahead of the market, so as the market was falling, we entered this put spread below the market, very similar to what we're trying to do right now with lows and FXY and some of the other ones, is kind of get a little bit ahead of the market so when it turns, we have an opportunity to take a profit. But with XOP here, two things happened. The stock rallied, which really helped our position, and we saw implied volatility drop. So we traded the right strategy at the right time. We were a little bit directional, and that's okay. But two things happened that made this position really decay in value much quicker and therefore show us a profit much quicker versus holding it all the way through September expiration. So again, real good case study on why you got to make certain types of strategy trades in certain markets. Again, not fitting that or pushing that square peg into a round hole. As always, I hope you guys really enjoy these videos. If you have any comments or questions, please ask them right below this video. I'll get back to all of those tonight or tomorrow before the open. And as always, if you are watching this video somewhere else online or on YouTube, and you're seeing this video and want to get these trading alerts, you just have to understand that this video and these trading alerts are sent out about 15 days after they're sent out to our members. So our members get them the same day, the same night that we make the trades, but everyone else out there gets it about 15 days after it goes out to our members. So the only way you can get these is to go ahead and sign up for your free trial at OptionAlpha.com. Go ahead and kick all the tires, try us out for 7 days, see if this is something that you guys like. Happy trading.